1. What is arbitrage? Arbitrage is a trading strategy that involves buying and selling a financial asset in different markets simultaneously to take advantage of price differences. The goal of the arbitrage is to make a profit with minimal or zero risk. Arbitrage opportunities arise when the same asset is priced differently in different markets or exchanges. An example of arbitrage is buying a stock on the NYSE and selling it on the LSE if the price of the stock is higher on the LSE. 2. How does arbitrage work? Arbitrage works by taking advantage of price discrepancies in different markets. Arbitrageurs buy an asset in one market where it's priced lower and sell it in another market where it's priced higher. The price difference between the two markets generates a profit for the arbitrageur. For example, if the price of gold in the United States is lower than the price of gold in Europe, an arbitrageur will buy gold in the US and sell it in Europe to make a profit. 3. What are the types of arbitrage? Triangular arbitrage. This involves exploiting price discrepancies between three different currencies. Covered interest arbitrage. This involves taking advantage of differences in interest rates between two countries. Reverse cash and carry arbitrage. This involves taking advantage of price discrepancies between the futures and spot markets. Statistical arbitrage. This involves using statistical models to identify trading opportunities. Merger arbitrage. This involves taking advantage of price discrepancies during a merger or acquisition. Convertible arbitrage. This involves taking advantage of price discrepancies between a convertible security and its underlying asset. 4. What are the risks associated with arbitrage? Arbitrage involves market risk, liquidity risk, and execution risk. Market risk is the risk of the asset's price changing unexpectedly. Liquidity risk is the risk of not being able to buy or sell the asset quickly enough. Execution risk is the risk of not being able to execute the trade at the intended price. 5. What are the benefits of arbitrage? The benefits of arbitrage include the ability to make a profit with minimal or zero risk, the ability to take advantage of market inefficiencies, and the ability to contribute to market efficiency by eliminating price discrepancies. 6. What is the difference between arbitrage and speculation? Arbitrage involves buying and selling an asset in different markets simultaneously to take advantage of price differences, while speculation involves buying or selling an asset in the hope of making a profit from price movements. 7. What is the difference between arbitrage and hedging? Arbitrage involves buying and selling an asset in different markets simultaneously to take advantage of price differences, while hedging involves taking a position in an asset to offset potential losses. 8. How do you calculate arbitrage profit? To calculate arbitrage profit, you need to subtract the cost of buying the asset in one market from the amount you receive for selling it in another market. Let's say you buy one Bitcoin for $30,000 on exchange A and simultaneously sell it for 32,000 Turkish lira on exchange B. The exchange rate between USD and Turkish lira is $1 equals half past 8 Turkish lira. To calculate the profit, we need to convert the sale price from Turkish lira to USD. 32,000 Turkish lira over half past 8 equals $3,764.71. Arbitrage profit equals selling price minus buying price equals $3,764.71 minus $30,000 equals $1,764.71. So the arbitrage profit in this case is $1,764.71. 9. What is triangular arbitrage? Triangular arbitrage involves exploiting price discrepancies between three different currencies. It involves converting one currency into another, then into a third currency, and finally back into the original currency, with the goal of making a profit. An example of triangular arbitrage would involve taking advantage of the exchange rate between the US dollar, the euro, and the Japanese yen. If the exchange rate of US dollar to euro is 0.85 and the exchange rate of euro to Japanese yen is 130, then the exchange rate of US dollar to Japanese yen should be 110.5, 0.85 by 130. If the actual exchange rate of US dollar to Japanese yen is lower than 110.5, then an arbitrageur could buy USD, convert it to euro, then convert the euro to JPY to make a profit. 10. What is covered interest arbitrage? Covered interest arbitrage involves taking advantage of differences in interest rates between two countries by investing in a currency with a higher interest rate and simultaneously hedging the currency risk by taking a forward contract in the foreign currency. The goal of covered interest arbitrage is to earn the difference in interest rates between the two currencies with minimal risk. For example, if the interest rate in the United States is 2% and the interest rate in Japan is 0.5%, an arbitrageur could borrow dollars in the US at 2%, convert them to yen, and invest them in a Japanese bond at 0.5%. The arbitrageur would then use a forward contract to hedge against currency risk. 11. What is reverse cash and carry arbitrage? Reverse cash and carry arbitrage involves taking advantage of price discrepancies between the futures and spot markets by selling the asset in the futures market and buying it in the spot market. The goal of reverse cash and carry arbitrage is to make a profit from the difference between the futures and spot prices. An example of reverse cash and carry arbitrage would involve selling a futures contract for oil at a higher price than the spot price of oil, then buying the oil in the spot market and taking delivery of it when the futures contract expires. 12. What is statistical arbitrage? Statistical arbitrage involves using statistical models to identify trading opportunities based on market inefficiencies, such as mispricings or correlations between assets. The goal of statistical arbitrage is to make a profit by exploiting these inefficiencies. An example of statistical arbitrage would involve using a quantitative model to identify a price discrepancy between two stocks that are highly correlated. The arbitrageur would then buy the undervalued stock and sell the overvalued stock to make a profit when the prices converge. 13. What is merger arbitrage? Merger arbitrage involves taking advantage of price discrepancies during a merger or acquisition. This involves buying the stock of the target company and selling the stock of the acquiring company. The goal of merger arbitrage is to make a profit from the difference between the offer price and the market price. An example of merger arbitrage would involve buying the stock of a company that is being acquired at a lower price than the offer price, then selling the stock at the offer price when the merger is completed. 14. What is convertible arbitrage? Convertible arbitrage involves taking advantage of price discrepancies between a convertible security and its underlying asset. This involves buying the convertible security and shorting the underlying asset. The goal of convertible arbitrage is to make a profit from the difference in prices between the two securities. An example of convertible arbitrage would involve buying a convertible bond and shorting the underlying stock if the bond is undervalued relative to the stock. The arbitrageur would then profit when the bond price increases or the stock price decreases, or both. 15. What is the difference between retail arbitrage and online arbitrage? Retail arbitrage involves buying products from a physical store at a low price and selling them at a higher price on online marketplaces. Online arbitrage involves buying products online at a low price and selling them at a higher price on other online marketplaces. 16. What is the difference between forex arbitrage and cryptocurrency arbitrage? Forex arbitrage involves taking advantage of price discrepancies between different currency pairs, while cryptocurrency arbitrage involves taking advantage of price discrepancies between different cryptocurrency exchanges. An example of forex arbitrage would involve buying euros with dollars in one market where the exchange rate is 1.15 and selling euros for dollars in another market where the exchange rate is 1.20 to make a profit. An example of cryptocurrency arbitrage would involve buying Bitcoin on one cryptocurrency exchange where the price is lower and selling it on another cryptocurrency exchange where the price is higher to make a profit. 17. What is the role of arbitrage in financial markets? Arbitrage helps to ensure that prices in different markets are consistent with each other, which contributes to market efficiency. It also helps to eliminate price discrepancies, which can reduce market volatility. 18. What is the impact of arbitrage on market efficiency? Arbitrage helps to ensure that prices in different markets are consistent with each other, which contributes to market efficiency. This can lead to lower transaction costs, increased liquidity, and reduced market volatility. 19. What are some famous arbitrage cases in history? One famous arbitrage case in history is the long-term capital management collapse in 1998. Long-term capital management was a hedge fund that used arbitrage strategies to make profits. However, the fund's use of leverage and high-risk arbitrage strategies led to massive losses and a financial crisis. Another famous case is the Salomon Brothers Treasury bond scandal in the 1990s, in which the investment bank was found to have manipulated the price of treasury bonds to increase profits from arbitrage trades. 20. How can I get started with arbitrage investing? To get started with arbitrage investing, you should research different types of arbitrage strategies and markets to find ones that suit your investment goals and risk tolerance. You should also develop a trading plan and risk management strategy to ensure that you can effectively execute your trades and manage your risk.